Hello everyone, welcome to another video for CFA Level 1. In today's video, the concept that we will be doing is beta. Okay, and why are we taking up this topic? If you look at it, we have skipped three topics after the risk model. One is the return generating model, second is the multi-factor model, and the third is the single index model. We have skipped it to come to beta. The reason is that in the previous class, we have done a deep dive on the risk, right? And we have understood what is unsystematic risk and what is systematic risk. Beta as a measure becomes a topic which is a very extension of the systematic risk, and thus we are excluding as of now those three topics and doing this topic. Once we are done with this, then we will do all the return models together because you have some return model after the beta as well. So we will take one class and we'll do all of them. Okay. Now what is beta? Okay, we will understand beta written as B with a a larger leg. Now what is beta? Beta is simple. Okay, beta is a measure of systematic risk. If I have to say in one line, beta is nothing. It is a measure of systematic risk. Okay. Now why do we need to measure systematic risk? Okay. The reason for measuring the systematic risk is that we have established from the capital market theory, we have established from the capital market theory, we have established from the capital market theory that an investor is rewarded only by the basis of systematic risk. Correct? We have seen it. Correct. In the previous class, we have seen it. An investor will be rewarded only basis the systematic risk that it takes. Why? Because unsystematic risk can be diversified away for free. Unsystematic risk can be diversified away for free. Correct? So what does it mean? It means that capital market theory was suggesting us that the returns that we will get will depend upon the systematic risk. Now, since return depends on systematic risk, thus it is very logical that there should be a measure. Since return is based on systematic risk, it is very logical that there should be a measure, or systematic risk should be quantified. Correct? Because if systematic risk is not quantified, then how do we say that based on X amount of risk I need Y amount of return? Correct? If we are unable to quantify systematic risk, how do we quantify the return that I deserve by taking that systematic risk? Guys, are we understanding? We are coming to a very deeper point. See, if I as a person, if I as an investor is unable to quantify the systematic risk that I'm taking, will I be ever able to quantify the return that I want? No. That is why quantification of systematic risk was very important. And in order to quantify the systematic risk, what measure we came out with is beta. Okay. Okay. Now on a similar note, see, we know total risk is usually indicated by sigma or sigma square, that is variance. Systematic risk, and we know we can compute it using standard deviation and variance measures. Standard deviation and variance measures. Correct? Systematic risk is beta. We know total risk is nothing but principally it is systematic risk plus unsystematic risk. Correct? We know principally total risk is nothing but systematic risk and unsystematic risk. So we have sigma, we have beta. If we if we find the residual point, we will get unsystematic risk. Approximately. Why we are doing approximation? Because this is not the actual way you get systematic risk. And secondly, there is no exact measure except for a residual method to compute unsystematic risk. Are we clear? Are we clear? So what we have seen the calculation of total risk, that is the standard deviation and variance. Now we have just been introduced to systematic risk and why it is necessary to quantify systematic risk. And then we have also had a understanding of how do we get unsystematic risk, and also of the fact that unsystematic risk, there is no direct measure to calculate it. It is always calculated as a residual term, that is total risk minus the systematic risk. Are we clear? Are we clear of the premise of beta? Why is beta needed? Right? See, anything that you study, okay, the first question that you should ask, and this is not only true for finance, this is true for any discipline that you are studying. Anything that you are studying, the first thing you should question is that why am I studying it? What is the need of it in the world, right? So let us come to beta. What is beta? Beta is the sensitivity of the asset return to the return of the market index in context of the market model. What is market model? Market model is nothing but the capital market theory that we were studying, which is saying that investors are rewarded based on the uh, systematic return, that the systematic risk that they take. Okay. Now, what is the definition of beta? Definition of beta. One definition that we have seen is nothing but measure of systematic risk. Okay. Now, what is that measure? What is that measure? Now, what is that measure? It is nothing but, now what is that measure? It is nothing but the sensitivity of the asset return to the market return. Okay. Which brings us to the third point of discussion. Which brings us to the third point of discussion, that is, what is sensitivity? How do we compute this sensitivity? Okay. Again, another point to understand that this is the slope of securities characteristic line. What is security characteristic line? We will do it at a later point. Okay, we will do it at a later point. It is the sensitivity of asset return to the return of the market. Now, what is the sensitivity? See, this sensitivity is calculated using correlation concept that we have understood. This sensitivity concept is calculated using the correlation that we have already studied. If you remember in our class, we have done the concept of correlation and covariance. Yes or no, guys? When did we do it? We did it in risk and return part 1. Correct? So what is beta? Beta of a security is nothing but the covariance of the security with the market. It is nothing but the covariance of the security with the market. divided by the standard deviation of the variance of the market, divided by the variance of the market. Guys, what is beta? Beta is nothing but, guys, what is beta? Beta is nothing but covariance of security return with market return, covariance of security return with market return divided by variance of market return. Guys, what is covariance? Guys, what is a covariance? We all know. Guys, what is a covariance? We all know covariance is a measure of how two variables move together. Correct? Now, when we are applying it in the context of beta in this two variable, one is the security return and the other is the market return. Okay. So what we are doing basically, we are measuring how the security returns are moving with respect to the market. Okay. Additionally, how you can do it? Beta is nothing but the correlation coefficient between the market and the security return into sigma I by sigma m. So what we are basically doing? We are doing nothing. We had this original expression, correct? We had this original expression, guys, but we know that covariance Im, but we know covariance Im divided by sigma m, sigma I is equals to nothing but correlation coefficient, correct? Correlation coefficient, what is this? Standardized measure, standardized measure of covariance, correct? So what does it mean? It means covariance is nothing but correlation into sigma m into sigma I. Now, now replacing it in the beta formula. So beta I is equals to covariance Im by sigma m square, which is also equal to correlation into sigma m into sigma I by sigma m square. Sigma m is excluded, which is nothing but correlation into sigma I by sigma m. So this is nothing but a derived formula, but although this is derived, but it has a major use in our study, major application is there. Okay, guys, are we clear? Guys, are we clear? Okay. Now, having understood the formula, uh, having understand the formula, and having understood everything, let us understand how to mathematically interpret beta. Okay. Last thing is that mathematical interpretation of beta. Correct. What is a mathematical interpretation of beta? Beta is nothing but a measure of systematic risk. It is the sensitivity of security return to a market return. So, the way you understand is that if beta is 1.1, what does it mean? It means that if market increases by 1%, then security return then security return will increase by 1.1% and vice versa. So basically what we are saying, when beta is expressed in mathematical terms, we can say that if beta is 2%, if beta is 2, then the security will move 2 times faster than the market. Okay. If beta was 2, we mean which means that if market moves by 1%, then security will move by 2%. Guys, are we getting it? Are we understanding the meaning of beta? Similarly, if we say that beta is minus 1.1, then what we are saying is that if market is increasing by 1%, security is falling by minus 1.1%, which means security is moving in the opposite direction to the market. Guys, are we getting it? Similarly, if suppose beta is 0.5, it means that if market is increasing by 1%, then security is moving by 0.5%. Correct. So basically, beta is showing how the movement of the security is with respect to that of the market. Guys, I hope this concept of beta is clear to you. I have tried to make it as efficient as possible. And guys, remember, this concept of beta will be with you forever in life till the time you are with finance. In level 1, in level 2, in level 3, every time beta will be there, you will be tested on a concept which will involve beta. So this is very important. Okay guys, thank you and best of luck for your studies and happy study.